Candles can be thought of as summaries of price action in a given period of time. For example, a chart can be representing the daily time frame, with each candle representing 1 day of price action. When reading candles, the O or open price represents the first price the financial instrument trades at in a given period of time. The close or C price is the final price of a financial instrument in a given period of time. For a bullish candle, such as the green one on the left, the price opens low and then eventually increases to close higher. Bearish candles are often represented in red because they represent a decrease in price from the open to the close. And whether it is a red candle representing a decrease in price or a green candle representing an increase in price, the open to the close represents a range that is referred to as the real body. Then the vertical line in the middle is referred to as the wick, and is sometimes called the shadow. It represents the range from the high H price to the low L price. It is possible for the open and low price to be the same for a bullish candle. In such a case, a green bullish candle would not have the lower wick range, which would normally be from the O to the L price. It's also possible for a green bullish candle to have the same close and high price. However, if this does not occur, the range from the high to the close of the green bullish candle is referred to as the upper wick. Likewise, a red bearish candle can have the same high and open price. However, if this does not occur, the range from the high to the open of the red bearish candle constitutes the upper wick of the red bearish candle. It is also possible for a red bearish candle to have the same close and low price. However, if this does not happen, the range from the close to the low of the red bearish candle is referred to as the lower wick. The most important time frame for candle charting is often the daily time frame. This is especially true for the stock market, which has very defined opening and closing hours. One of the main reasons for this is because the daily time frame is often the default setting for most charts. When you look up a chart, it will often be displayed in the daily time frame, whether it is a candle chart or not. The daily time frame is also a good balance between the finer details of shorter time frames and the bigger picture presented by longer time frames. For example, a 15-minute intraday chart where each candle represents 15 minutes of price action is good for understanding finer details in the very short term. However, it may create too much noise or insignificant information when looked at from a longer-term perspective. Then when looking at longer-term timeframes from the weekly and beyond, there is a good representation of the larger context. However, that comes at the cost of lost precision and detail. Of course, traders and investors as a collective group often have diverging interests in terms of the time horizons they hold and the time frames they are interested in. Nevertheless, it will still be quite common for most all market participants to frequently reference the daily time frame, as it does represent the current status of the market, with an adequate amount of short-term detail and long-term perspective. Generally, the open and close are the most important prices, because normally most market activity takes place during the start and finish of a particular session, especially applicable to the daily time frame. There can still be lots of activity around the high and low prices. However, this is less common, and even if it does happen, the impact will be less long-lasting compared to the effects of opening and closing prices. Of course, these are all generalizations. There can be some exceptions from time to time, but in the majority of cases, the open and especially the close price will be the most important. As we will see in the coming series of examples, All the O, C, L, and H prices do play an important role in identifying the current market situation. However, certain context, such as the particular candle formation and the surrounding market structure, will determine which price or prices may be more important in a particular case.